Welcome to this comprehensive guide on navigating the fascinating world of cryptocurrency market cycles. Whether you're new to crypto investing or looking to refine your strategy, this presentation will equip you with the knowledge to make informed decisions for long-term success. Together, we'll demystify market patterns, explore the psychology behind price movements, and develop strategies to help you remain calm and focused through market volatility. Let's begin this journey toward becoming more confident crypto investors. Cryptocurrency markets don't move in straight lines. They follow recurring patterns of ups and downs that form predictable cycles. Understanding these cycles isn't just academic, it directly impacts your financial well-being and emotional state as an investor. When you recognize where we are in a market cycle, you gain the power to make rational decisions instead of emotional ones. This awareness helps you avoid common pitfalls like buying at peak excitement, FOMO, or selling during moments of market panic. For long-term holders, market cycles provide the context needed to stay committed to your investment strategy, even when short-term volatility creates uncertainty. Market cycles are fundamentally driven by collective human emotions, particularly fear and greed. These emotions create predictable patterns in buying and selling behavior. While no two cycles are identical, they typically follow a similar progression through distinct phases that we can learn to recognize and anticipate. These psychological factors manifest as recurring price movements that tend to follow similar patterns over time, though with varying themes and intensity. Cycles are influenced by news events, technological developments, regulatory changes, and broader economic conditions that affect investor sentiment. The four phases of a crypto market cycle are accumulation, markup, distribution, and markdown. The accumulation phase occurs after a market bottom where prices stabilize and early investors begin buying. The markup, or bull run phase is when prices rise steadily and public interest grows. The distribution phase is where prices plateau and early investors begin taking profits. Finally, the markdown, or bear market phase is when prices decline and sentiment turns negative. Understanding these phases helps investors make informed decisions at each stage of the cycle. The accumulation phase marks the beginning of a new market cycle, typically emerging after a prolonged downturn. During this period, prices find a bottom and begin to stabilize, though they remain significantly below previous highs. Market sentiment during accumulation is often pessimistic or indifferent. Media coverage of cryptocurrency becomes scarce, and public interest wanes as many casual investors have exited the market after experiencing losses. Meanwhile, experienced investors and those with strong conviction in the technology's long-term potential begin quietly accumulating assets at discounted prices. This smart money sees value where others may not. Signs that you're in the accumulation phase include low trading volumes, as speculative traders have largely exited the market. Daily trading ranges may be narrower with less volatility. Negative sentiment is prevalent, with social media and news coverage often containing pessimistic headlines about crypto's future. You might hear phrases like crypto winter or blockchain is dead frequently in media narratives. Price stabilization occurs after a sharp decline, as prices begin to find support levels and stop moving as low. During this phase, core development work continues on fundamental projects. Genuine innovations are quietly being built while the market's attention is elsewhere. The accumulation phase presents one of the best opportunities for long-term holders to establish or add to positions at favorable prices. Historical data shows that investments made during this phase often yield the most significant returns. Use this quieter period to conduct thorough research on projects that have survived the downturn and continue to show development progress despite challenging market conditions. These resilient projects can provide a strong foundation for future growth. Consider dollar cost averaging, DCA, during this gradually build positions without trying to time the market. Such an approach helps mitigate risk while ensuring you don't miss the opportunity presented by lower prices. Prepare yourself psychologically for the possibility that prices will remain flat or decline further before any upward trends begin. Patience during this phase is crucial. Accumulation periods can last months or even years. The markup phase represents the most exciting period in the market cycle, characterized by sustained price increases and growing optimism. This is the classic bull market that attracts widespread attention. Early in this phase, prices begin consistently making higher lows and higher highs, a key technical indicator of a new uptrend. As momentum builds, trading volumes increase substantially and price movements accelerate. Media coverage turns increasingly positive, with more mainstream outlets reporting on cryptocurrency price movements and success stories. New investors begin entering the market, drawn by rising prices and the fear of missing out, FOMO. Signs that you're in the markup phase include a consistent upward pattern of higher highs and higher lows, creating an upward trend line that can be observed across multiple timeframes. Price corrections become shallower and shorter in duration. Media coverage becomes more frequent in mainstream financial media, often with a positive tone to most positive reporting. Success stories of early investors making substantial gains begin to circulate widely. Trading volumes grow significantly compared to the accumulation phase, as more participants enter the market, creating strong demand that pushes prices higher with each wave of new participants. The launch of new cryptocurrency projects and token offerings increases as entrepreneurs and developers look to capitalize on market enthusiasm. Funding for blockchain startups becomes more accessible. Within the markup phase, there are distinct stages that investors experience. The early bull, or disbelief, stage is when investors remain skeptical that a new bull market has truly begun. Prices start rising but are frequently met with skepticism as previous investors who experienced losses look to break even and exit. The middle bull, or belief, stage is when price increases become more widely accepted as part of a new trend. New investors begin entering the market in increasing numbers, and mainstream media coverage turns more positive. The late bull, or euphoria, stage is when price movements accelerate dramatically as FOMO, fear of missing out, behavior begins building. Media coverage becomes overwhelmingly positive, with extreme price predictions becoming common. During the markup phase, it's important to avoid emotion-based decisions. Resist the temptation to abandon your strategic plan by making impulsive purchases based on fear of missing out. Stick to your research and investment thesis rather than chasing short-term price movements. While maintaining your core long-term holdings, consider whether taking some profits on a portion of your portfolio aligns with your financial goals. This creates dry powder for future opportunities while locking in some gains. Over time, as the market ascends, your portfolio allocation may drift from your target asset distribution. Periodically assess whether rebalancing is needed to maintain your desired risk profile and diversification. Even in strong uptrends, significant corrections of 30–40% are common in crypto markets. Having a predetermined plan for how you'll respond to these pullbacks helps keep your emotions in check. The distribution phase marks the transition from a bull market to a bear market. During this period, prices reach their peak and begin to show signs of exhaustion after a prolonged uptrend. The market often becomes highly volatile with dramatic price swings in both directions. Early investors and institutional players who accumulated at much lower prices begin to sell and distribute their holdings to newer market participants who are still buying based on momentum and FOMO. This phase is characterized by mixed signals. Prices may still attempt to make new highs, but these are often rejected. Technical indicators might show divergences, with price making higher highs while metrics like volume or momentum make lower highs. Signs that you're in the distribution phase include price exhaustion, where after making new all-time highs, prices struggle to continue higher. Each new high requires more buying pressure but produces smaller percentage gains than previous moves. Price movements become more erratic with larger daily swings in both directions. The market becomes increasingly sensitive to news events, with stronger reactions to negative developments. Key technical indicators like Relative Strength Index, RSI, or on-chain metrics begin showing bearish divergences, where price makes new highs while these indicators make lower highs. Media coverage reaches peak optimism with absurdly high price predictions. This is often dominated by cryptocurrency discussion, with many new investors expressing high conviction despite limited understanding. The psychology of the distribution phase often involves overconfidence, as investors become complacent after experiencing substantial gains, leading to decreased risk awareness and increased leverage. Many believe that the bull market will continue indefinitely. As prices begin making lower highs and lower lows, many investors deny that the trend has changed. Each bounce is seen as confirmation that the bull market is resuming, even as the overall pattern shifts downward. Market sentiment reaches extreme optimism. Price discussions focus almost entirely on how high assets will go rather than on fundamentals or risk management. Cryptocurrency becomes a common topic in mainstream conversations. Conflicting signals create confusion. Some technical indicators suggest further upside while others show warning signs. Debate intensifies about whether the market has peaked or is merely consolidating before another leg up. During the distribution phase, it's crucial to manage your risk management focus during this phase. This might involve setting trailing stop losses on a portion of your holdings or predetermining price levels where you'll take profits. Be especially skeptical of new paradigm narratives suggesting that traditional market dynamics no longer apply. Claims that this time is different often emerge near market tops and prove untrue in the long run. For long-term holders, this may be an appropriate time to take some profits, particularly on assets or sectors that have significantly outperformed your expectations. This creates reserves for future opportunities. Fundamental reassessment is essential to create realistic value for your holdings. For truly long-term positions in assets you believe have lasting value, distributions during this phase can provide opportunities to reassess and adjust your portfolio for the future. The markdown phase represents the most challenging period for investors psychologically. During this phase, prices decline consistently, often retracing a significant percentage of the previous bull market's gains. This bear market is characterized by lower highs and lower lows on price charts. Each rally is met with selling pressure as investors who didn't exit during the distribution phase look for opportunities to minimize losses or exit at better prices. Media coverage turns overwhelmingly negative during the markdown phase, with headlines questioning the long-term viability of cryptocurrency technology. Public interest wanes significantly, and trading volumes decline as speculative participants exit the market. Signs that you're in the markdown phase include a consistent downward price trend, forming a clear pattern of lower highs and lower lows across multiple timeframes. Each bounce is weaker than the last and fails to break previous resistance levels. Support levels that previously held are broken, leading to further selling. Negative media coverage focuses heavily on price declines, project failures, and regulatory concerns. Articles questioning whether cryptocurrency has a future become common, and mainstream media coverage decreases in frequency. Transaction volumes decline significantly compared to the markup phase, as fewer participants are active in the market. Periods of sideways price action show particularly low volume as interest in the market diminishes. Project failures and exits become more frequent as startups announce layoffs and budget cuts. The rate of new project launches decreases dramatically compared to the bull market. Within the markdown phase, there are distinct stages that investors experience. The early bear, or anxiety, stage, is when investors begin to realize the trend has changed and must adjust their mindset that declines will be short-lived. Many view the correction as healthy and expect a quick return to the uptrend. Price drops are often met with "buy the dip" responses. The middle bear, or denial, stage, is when prices continue falling and break key support levels. Denial gives way to concern. Investors start questioning their holdings but remain reluctant to sell at a loss. Each bounce creates hope that the bottom has formed. The late bear, or capitulation, stage, is when prolonged price declines. Many investors give up and sell regardless of price, often leading to dramatic sell-offs. Sentiment reaches extreme pessimism, and declarations that "crypto is dead" become common. The psychology of the markdown phase involves anxiety as prices begin to fall consistently. Investors become increasingly concerned about their holdings. They closely monitor prices and news, hoping for signs of reversal while worrying about further declines. Fear begins to dominate decision-making as investors worry about losing more of their investment. Many begin questioning their investment thesis entirely. After sustained losses, many investors reach a breaking point where emotional pain overcomes rational thinking. They begin selling regardless of price, often near market bottoms when sentiment is bleakest. Depression sets in as investors work through significant losses. Investors may experience feelings of regret, self-doubt, and pessimism about the future of their investments and cryptocurrency in general. The markdown phase tests emotional resilience more than any other. Remind yourself of your original investment thesis and time frame. If the fundamental case for your investments remains intact, your long-term vision shouldn't dictate your actions. Keep your eye on price charts to maintain perspective. Despite significant corrections, each crypto market cycle has historically resulted in higher lows than the previous one. For those with available capital and strong conviction, bear markets present opportunities to accumulate assets at discounted prices. Consider a disciplined approach like dollar-cost averaging rather than trying to time the exact bottom. Knowledge building is crucial. Improve your analytical skills, and research projects that continue building despite market conditions, which prepares you for the patience to withstand downturns. Bitcoin halving is a programmed event that occurs approximately every 4 years, reducing the reward for mining new blocks by half. This process effectively reduces the rate of new Bitcoin creation, decreasing its inflation rate. Historically, Bitcoin halvings have preceded major bull runs, though not immediately. The reduction in new supply creates a potential supply-demand imbalance if demand remains constant or increases. Many analysts view the halving as a fundamental driver of Bitcoin's approximately 4-year market cycle, with prices typically reaching a peak 12-18 months after each halving, followed by a retracement and consolidation phase before the next halving. This chart illustrates Bitcoin's price history across multiple market cycles. Despite significant corrections during bear markets, each cycle has produced higher lows than the previous one. While past performance doesn't guarantee future results, this pattern has been consistent throughout Bitcoin's history. The cyclical nature becomes apparent when viewing this extended time frame, with each major peak followed by a substantial correction and accumulation period before the next uptrend begins. In line with previous market cycles, Bitcoin has traditionally followed an approximate 4-year cycle from peak to peak. This aligns roughly with the halving schedule, though the exact timing varies. Altcoins often follow Bitcoin's broader cycle but with more extreme movements. Their cycles may be compressed or extended compared to Bitcoin depending on project-specific development. As the cryptocurrency market matures with greater institutional participation and regulations, cycle lengths and characteristics may change. Each cycle has shown unique attributes while maintaining similar psychological patterns. There is ongoing debate among analysts about whether cryptocurrency market cycles are lengthening as the market matures. Some evidence suggests that recent cycles have extended beyond the traditional 4-year pattern, with longer periods between extreme peaks and troughs. Several factors could contribute to lengthening cycles. Increased market capitalization making rapid price movements more difficult, growing institutional participation introducing more measured investment approaches, regulatory developments creating more structured market environments, and market efficiency reducing information asymmetries. The lengthening cycles theory suggests that each successive market cycle takes longer to complete than the previous one. If true, this could mean longer accumulation phases and more gradual transitions between bull and bear markets in the future. However, this remains a theory rather than a proven pattern, and the relatively short history of cryptocurrency markets makes definitive conclusions difficult. Timing in cycle phases helps you identify more favorable times to enter positions, improving long-term returns. Emotional management is crucial, as market movements in cycles can lead to dramatic ups and downs. Realistic expectation setting helps investors understand that bull markets don't last forever, while knowing bear markets eventually end aids in maintaining hope during downturns. Strategic planning with cycle awareness allows you to develop phase-appropriate strategies, such as accumulating during bear periods and maintaining core positions for long-term growth. The Crypto Fear and Greed Index is a tool that quantifies market sentiment on a scale from 0-100, where 0 represents extreme fear and 100 represents extreme greed. The index analyzes factors like volatility, market momentum, social media activity, and surveys to gauge sentiment. Extreme readings often signal potential market reversals, with extreme fear indicating oversold conditions and extreme greed suggesting overbought conditions. While useful as one data point, the Fear and Greed Index shouldn't be used in isolation for investment decisions. It's a lagging indicator that reflects current sentiment rather than predicting future movements. Technical analysis, on-chain metrics, historical timelines, and social sentiment analysis are key tools for identifying market phases. Chart patterns, moving averages, and indicators like RSI and MACD can help identify trends and potential reversal points. Blockchain data like active addresses, transaction volumes, and realized value can provide insights into network activity and investor behavior. Studying previous cycles provides context for current conditions, while social media activity offers insight into public interest and sentiment. These tools, when combined, can help gauge public interest and sentiment, providing a comprehensive view of market dynamics. On-chain metrics like MVRV, NVT ratio, and SOPR provide valuable insights into Bitcoin's market cycles. MVRV compares Bitcoin's market capitalization to its realized capitalization, indicating potential market tops and bottoms. NVT ratio compares network value to transaction volume, helping identify overvaluation or undervaluation. SOPR indicates whether Bitcoin holders are selling at a profit or loss, with values consistently below 1 suggesting losses. These metrics help investors understand market conditions and make informed decisions. Psychological biases like herding, recency, confirmation, and anchoring can significantly impact investment decisions during market cycles. Herding bias leads investors to follow the crowd, buying during bull markets and selling during bear markets. Recency bias causes investors to overweight recent events, expecting trends to continue. Confirmation bias leads investors to seek information that supports existing beliefs, ignoring contradictory evidence. Anchoring bias causes fixation on specific price points, affecting buying and selling decisions. Understanding these biases can help investors make more rational decisions. Stoicism, a philosophy focused on virtue and emotional resilience, offers valuable principles for navigating cryptocurrency market cycles. The core idea of focusing only on what you can control while accepting what you cannot is particularly relevant for investors. During market cycles, you can control price movements and market volatility, actions of other market participants, regulatory developments and news events, and exact timing of cycle phases. By focusing energy on these controllable factors, you can make more rational decisions regardless of market conditions and maintain emotional equilibrium through volatile market phases. Strategic approaches for different cycle phases include accumulation, markup, distribution, and markdown strategies. Accumulation strategy focuses on gradual position building in high-conviction assets, while markup strategy involves maintaining core positions with selective profit-taking. Distribution strategy focuses on reducing exposure to higher-risk assets, and markdown strategy emphasizes preservation of capital and emotional discipline. Each strategy is tailored to specific market conditions, helping investors navigate cycles effectively. Dollar-cost averaging is an investment strategy where you invest a fixed amount at regular intervals, regardless of price. This approach helps mitigate the impact of market volatility, allowing you to buy more when prices are low and less when prices are high. Consistent investing helps build your position steadily, providing a long-term perspective through cycle fluctuations. Psychological benefits include reduced anxiety about timing the market perfectly, as regular investments smooth out the effects of price swings. Value averaging is a modified version of dollar-cost averaging where you adjust your investment amount to reach a predetermined portfolio value at each interval. This approach can enhance returns compared to standard DCA but requires more active management. By focusing on target portfolio values, you can buy more during downturns and less during upswings, helping maintain a long-term perspective through cycle fluctuations. Long-term investors face a challenging question. If you believe in an asset's long-term potential, should you sell during a market uptrend? Taking partial profits during uptrends can help balance risk and reward, allowing you to recover your initial investment while maintaining significant upside exposure. Another approach is portfolio rebalancing, where you maintain target allocation percentages across different assets. This creates a balanced strategy between core investment and active management. Reducing emotional decision-making during market cycles involves creating a detailed investment plan, using automated purchases, maintaining an investment journal, and setting an information diet. Automation helps remove the need to make active decisions during volatile periods, while an investment journal provides perspective during emotional times. Setting specific times to check your portfolio rather than reacting to news helps maintain focus on fundamental developments over price predictions. FOMO, or fear of missing out, is the anxiety that you're missing profitable opportunities during bull markets. Recognizing the signs of FOMO, such as urgency to buy now before it's too late, can help prevent impulsive investments. Prevention strategies include sticking to predetermined investment amounts, implementing mandatory waiting periods before making unplanned purchases, and reviewing your original investment thesis before making decisions. Calculating potential losses in dollar terms, not just percentage gains, and reviewing historical charts can provide context for typical price increases. Preparing for bear markets involves focusing on long-term investment strategies and maintaining perspective despite dramatic corrections. It's important to understand the fundamental case for your investments and consider tax implications when selling. By focusing on longer time-frame charts, you can maintain perspective during bear markets and avoid panic selling. Consulting with a tax professional can help navigate tax loss harvesting and re-establishing positions after wash sale periods. Altcoin cycles often differ from Bitcoin cycles, with altcoins experiencing delayed reactions and amplified movements. During bull markets, altcoins can outperform Bitcoin significantly, while during bear markets, they may experience sharper declines. Factors like Bitcoin dominance, project-specific developments, and regulatory changes can influence altcoin cycles. Understanding these differences can help investors navigate the broader crypto market. Altseason refers to periods when alternative cryptocurrencies experience explosive price growth, often during the middle to late stages of bull markets. These phases can offer significant gains but also temporary instability. Altseasons represent both opportunity and danger for investors, with smaller cryptocurrencies potentially tripling in value within weeks or months. Navigating altseason involves focusing on projects with unique utility and development activity, maintaining core positions in larger, more established cryptocurrencies, and being prepared for swift reversals when the trend changes. Market cycles affect different types of cryptocurrencies, including assets like Bitcoin, smart contract platforms, DeFi tokens, and NFTs. Each type has unique cycle characteristics, influenced by factors like innovation waves, regulatory changes, and mainstream adoption. Understanding how market cycles impact these different types can help investors make informed decisions and navigate the broader crypto market effectively. Volatility in cryptocurrency markets is not constant. It follows a distinct pattern throughout different market cycles. As we move from early accumulation phases to late bear phases, volatility tends to increase, peaking during bull markets. Understanding these patterns can help investors anticipate market movements and make informed decisions. The relationship between cryptocurrency and traditional financial markets has evolved significantly, showing increased correlation over time. This suggests that macro factors like interest rates and liquidity conditions can affect both markets similarly. However, there are periods when crypto markets decouple from traditional ones, often driven by crypto-specific events. Diversification remains crucial to navigate these dynamics effectively. Several macroeconomic factors play a crucial role in influencing cryptocurrency cycles. Interest rates, inflation, dollar strength, and global liquidity are key drivers. For instance, higher interest rates can accelerate crypto corrections, while inflation can impact crypto in complex ways. Understanding these factors can help investors anticipate potential market shifts. Institutional investors are increasingly participating in the cryptocurrency market, bringing about significant changes. Their involvement leads to increased market stability and professional trading infrastructure, which can reduce volatility and alter price movements. Institutions often operate under stricter risk management frameworks, influencing market dynamics. Regulatory changes can have profound effects on cryptocurrency market cycles. Short-term volatility often arises from regulatory announcements, while adoption impact can drive institutional interest. Jurisdictional differences and evolutionary patterns also play a role, highlighting the importance of understanding regulatory landscapes in crypto investing. The 2017-2018 cycle was marked by significant events, including the distribution phase and subsequent markdown phase. Bitcoin's price reached new highs before experiencing a dramatic decline. This period serves as a valuable case study for understanding market dynamics and investor behavior during different phases of a cycle. The 2020-2022 cycle was influenced by the COVID crash and recovery, NFT and DeFi boom, institutional adoption, and rate hikes. Each event played a role in shaping the market, highlighting the importance of adaptability and understanding external factors. This cycle underscores the complexity and rapid evolution of the cryptocurrency landscape. Each market cycle has distinct characteristics, from the early days dominated by tech enthusiasts to the current cycle influenced by institutional products and regulatory developments. Understanding these differences is crucial for navigating the market effectively and anticipating future trends. Cryptocurrency market cycles have evolved significantly, with each cycle showing unique traits. As cycles mature, they tend to lengthen, with decreasing volatility and changing return profiles. Increasing complexity is evident, with more participants and integration with traditional markets, highlighting the need for strategic adaptation. Technical analysis plays a vital role in identifying market cycles. Tools like moving averages, RSI, logarithmic regression, and volume profiles help investors understand market conditions and potential trends. These techniques are essential for making informed decisions and optimizing investment strategies. Preparation is key for navigating upcoming market cycles. Financial readiness, strategic planning, and infrastructure familiarization are crucial steps. By understanding blockchain technology and investment principles, investors can position themselves effectively for future opportunities and challenges. Building a cycle-resistant portfolio involves diversifying across different asset classes and strategies. Long-term core holdings, established altcoins, sector-based investments, speculative opportunities, and stable coins, cash reserves are essential components. This approach helps mitigate risks and capitalize on market opportunities. Effective risk management is crucial across different cycle phases. From accumulation to markdown, strategies like position sizing, stop losses, and reassessment are vital. Understanding the unique risks and opportunities of each phase can help investors protect their portfolios and optimize returns. Investors often make mistakes by misjudging cycle phases, leading to poor timing and decision-making. Overtrading and narrative chasing are common pitfalls. Recognizing these errors and understanding market sentiment can help investors avoid costly mistakes and improve their investment strategies. Past cycles offer valuable lessons for investors. Embracing patience, understanding fundamentals, and recognizing market sentiment are key takeaways. By learning from previous experiences, investors can navigate future cycles more effectively and make informed decisions. The Bitcoin Rainbow Chart is a popular tool for visualizing Bitcoin's price in the context of market cycles. It helps investors understand sentiment and make strategic decisions. However, it's important to recognize its limitations and use it alongside other analysis methods for a comprehensive view. Long-term holding requires developing patience and conviction. Focusing on the bigger picture and connecting with like-minded investors can provide emotional support during market phases. This approach helps investors maintain discipline and make rational decisions, leading to long-term success. Developing a personal strategy based on cycle knowledge involves assessing risk tolerance, time horizon, and technical comfort level. By aligning these factors with personal circumstances, investors can create tailored strategies that optimize their portfolios and enhance their investment outcomes. Understanding cryptocurrency cycles is crucial for successful investing. Recognizing phase-appropriate strategies, emotional influences, and maintaining a long-term perspective are key takeaways. These insights help investors navigate market dynamics and make informed decisions. Thank you for joining us in exploring cryptocurrency market cycles. We hope this presentation has equipped you with valuable insights for navigating these cycles with greater confidence and perspective. Remember, understanding cycles is about developing patience, emotional discipline, and strategic thinking that leads to long-term success.